To compound your money and not your mistakes, your goal is to buy on the way up, not on the way down. I fear not the man that has practiced 10,000 kicks once, but I fear the man that has practiced one kick 10,000 times. There really is no intelligent reason to increase your trading size if your positions are showing losses. If you want to be the best, you have to do things that other people are unwilling to do. Those who succeed big at anything all have the same attitude: you keep going until it happens or you die trying. Quitting is not an option. It's better to lose correctly than to win incorrectly. The difference between interest and commitment is the will not to give up. When you truly commit to something, you have no alternative but success. Growth comes at the expense of comfort. Losers average losers. You want to get on board when institutional money is pouring into a stock and lifting it significantly. Virtually every superperformance phase in big, winning stocks occurred while the stock price was in a definite price uptrend. In almost every case, if you find yourself getting stopped out of your positions over and over, there can only be two things wrong. 1. Your stock selection criteria are flawed. 2. The general market environment is hostile. Specialists get paid well, while those who know a little about many things make good conversation at parties. Mastery requires sacrifices, therefore, something must come first. Make a list, prioritize, and pursue accordingly. Focus, achieve, and then move to the next big goal. If you don't have a plan, you will surely experience paralyzing emotions and second-guess yourself at key decision-making moments. Luck is a short-term phenomenon. In the long run, luck is for losers. Trading is serious business with real money on the line. Why would you go into it without a well-thought-out plan of action? Yet, most people do. Investing styles may differ among successful market players, but without exception, winning stock traders share certain key traits required for success. Fall short in those qualities and you will surely part ways with your money. Not losing big is the single most important factor for winning big. As a speculator, losing is not a choice, but how much you lose is. Long-term success in the stock market has nothing to do with hope or luck. Winning stock traders have rules and a well-thought-out plan. Conversely, losers lack rules, or if they have rules, they don't stick to them for very long, they deviate. During a difficult trading environment, your gains will be smaller and less frequent than during a healthy market. When this occurs, remember one word: adjust. Always think risk in relation to reward. You must adjust your risk as a function of potential reward. Expectancy is your percentage of winning trades multiplied by your average gain, divided by your percentage of losing trades multiplied by your average loss. Maintain a positive expectancy, and you're a winner. My results went from average to stellar when I finally made the choice that I was going to make every trade an intelligent risk-reward decision. When you sell half, if the stock goes higher, you say to yourself, "Thank goodness I kept half." If the stock goes lower, you'll say, "Thank goodness I sold half." Psychologically, it's a win-win either way. There have been too many times when I have been shaken out of a good position by looking at the short-term time frame. I went from mediocre to a stellar performer when I told myself, "To heck with worrying about the money and obsessing over the scoreboard. I'm just going to focus on being the best trader I can be and sticking to the rules." Then the money followed. Focus on becoming the best trader you can be, money and success will follow. This quote from multi-billionaire trader Bird changed everything. In the stock market, you can make money or you can make excuses, but you can't make both. Do whatever it takes to eliminate your own personal excuses. Your road to success starts by taking responsibility. Don't blame outside factors for your lack of success. It doesn't feel great breaking even on a trade that was once a profit, but it feels a lot better than when you let a good-sized gain turn into a losing trade. You must not risk more than you can reasonably expect to gain, otherwise, you're stuck. Once I make a profit, that money belongs to me. Yesterday's profit is part of today's principal. The law of detachment reminds you that becoming too attached to any outcome, whether a particular goal or even a particular person, can ruin your life. You become desperate, and you clutch and cling. Detach from the result and remind yourself that the current condition is only temporary, just part of the process. You will get there because you are committed to putting one foot in front of the other until you win. The reason most investors fail to sell and cut their loss short is because they fear that after they sell the stock might go back up and they will be wrong twice. It's driven by the fear of regret, which stems from pure ego. I want to be at a profit immediately. If I don't see a profit very soon after I buy the stock, I'm inclined to just get out. When a stock is breaking out of a base, I like to see huge volume that is many times greater than the average volume during the last 50 days. I also like to see that the volume continues higher for at least 3 days. That will be a sign that the large institutions and hedge funds are also buying. If the stock breaks to new highs on volume for 1 day and has no follow-through, then that indicates to me it was just a bunch of traders playing the new high. There are many distractions that can cloud your judgment when trading. Your job is to keep your thinking pure and focused on what matters within your own circle of competence. The hallmark of a pro is to operate within this circle and ignore everything else. Welcome to the slippery slope. When you tell yourself, I'm going to break my rule just this once, you open the door to losing discipline, because it's never just one time. It's like an alcoholic saying just one drink. If you're like most traders, your emotions fluctuate constantly between two emotions and you struggle with the following: indecisiveness, should I buy, should I sell, should I hold, and regret, I should have bought, I should have sold, I should have held. Speculation is anticipating coming movements and then waiting to be proven right or wrong. You go in with a plan and execute it. Then, after the trade is completed, you evaluate the results, troubleshoot your approach, and come back in with a new plan of attack. The key is to see things as they are, operating in the now, without seeing things as worse than they are out of fear, or better than they are out of greed. If you want to mitigate risk effectively, you simply must acknowledge that stocks don't manage themselves. You're the manager, and it's up to you to protect your hard-earned capital. With every trade I make, my approach is always risk first. By thinking and acting risk first, you know exactly what you stand to lose if you're wrong, which in trading is far more important than what you stand to gain if you're right, because if you lose all your chips, the game is over. There is no such thing as a safe stock. That's like saying there's such a thing as a safe race car. Like race cars, all stocks are risky. With each buy order I enter, I know the exact price where I am going to sell at a loss if things don't work out as expected. I define this price level before I get in. Trading without a stop loss is like driving a car without brakes. Maybe you could make it around the block a few times, but if you did drive without brakes, how far do you think you could go before you crash? Those who trade without a stop eventually stop trading. Hope is not a strategy. The main thing is that you cut your loss immediately, without any vacillation. Your goal as a stock speculator is preparedness, to trade with few surprises. To do so, you need to develop a dependable way to handle virtually every situation that may occur. Calculating risks shrewdly is the main ingredient for consistent superior performance. Pros play percentage ball, and that's why, in the long run, they are more consistent than amateurs. Therefore, it could be said that the difference between an amateur and a pro lies in consistency. Relying on the probabilities based on a positive mathematical expectation to win your edge will lead to success. Big winning stocks will display the following characteristics: follow through price action after a breakout, more up days than down days and more up weeks than down weeks, tennis ball action, resilient price, snapback after a pullback, strong volume on up days and up weeks compared to down days and down weeks, more good closes than bad closes. By keeping track of your results, you will gain insight into yourself and your trading that no book, seminar, indicator, or system could ever tell you. The fact is, measuring results is not very popular because most people don't like to look at their bad trades. They choose to just forget about them as if they are going to magically improve with little effort and study. This is lazy and a big mistake. The first step to success in the stock market is to get your head out of the sand, and that starts with post-analysis of your results. The most valuable information about your trading is your trading. Part of that plan is sacrificing trades that carry too much risk. There are only 4 things in trading that you can control directly: what you buy, how much you buy, and when you sell. That's it. Making the decision to cut your loss in a stock requires that you accept the notion that only you can be wrong. The market is never wrong. If you want to reap big gains in the market, make up your mind right now that you are going to separate trading from your ego. It's more important to make money than it is to be right. You need to associate pleasure with small losses and pain with large losses. What exactly are you trying to accomplish? Do you want to make money, or are you engaged in an exercise in ego to prove that, somehow, you know more than the market? Numbers won't do anything to improve your psychology or mental preparedness. The road to success in the stock market is not a system or strategy, it's within you, and it will be realized only to the extent that you are able to control and direct your emotions as you encounter challenges. A good company is not always a good stock. A stock trading strategy is like a marriage. If you're not faithful, you probably won't have a good outcome. As long as the price holds above my stop loss, I try to give the stock some room. Before I enter a stock position, the first thing I do is decide where I'm going to cut my loss. As the stock moves up, my priority changes to protecting my break-even price. If I'm fortunate to have a decent gain, my priority shifts to protecting my profit. By keeping your losses small, you preserve your hard-earned capital for future investments. Chart patterns are not the cause, they're the effect. Human behavior hasn't changed and isn't likely to change much in the future. Don't force trades, wait for proper stock setups. How long? As long as it takes. If analyzing balance sheets were the holy grail for stock investing, accountants would be the world's greatest traders. If you can't learn to accept small losses, sooner or later you will take big losses. If you can't manage risk, you will never perform really well over time. Super performance will at best be a hit or miss affair. In time, there will always be a trade that meets your criteria and delivers easy dollars. And over time there will always be fools that rush and lay the groundwork for such opportunities. It doesn't really matter what you think about a stock. What matters is what big institutions think, because they are the ones that can move a stock price dramatically. It's more important to make money than it is to be right. No one will ever be so good that he or she will never take a loss. Being wrong is unavoidable, but staying wrong is a choice. Only get aggressive when trades are working well, scale back when they're not. The market can and will break anyone who ignores the risks and dangers. 4 very dangerous words, just this one time. It's better to lose correctly than to win incorrectly. Whatever gifts or ability someone might have been born with, success in the market comes from a concerted effort and a willingness to allow the learning curve to unfold, no matter how long it